In a single year, silver surged over 127%, platinum followed with a staggering 120% rally, and gold smashed through price ceilings that economists once called mathematically impossible. This wasn't a normal bull market. This was a warning flare fired into the global financial sky. While most investors were distracted by headlines and short-term noise, the metals market was quietly shifting beneath the surface, cracking, stretching, and preparing for something much bigger. This video is not about hype. It's about structure, supply, and power, and how those forces are colliding as we race toward 2026. Because when markets move like this, history tells us one thing clearly: someone knows something, and most people find out far too late. Stay with me, because what's coming next could redefine wealth, scarcity, and financial survival. Here's what should immediately grab your attention. Silver, platinum, and gold did not rise independently. They moved together in a synchronized pattern that seasoned analysts recognize as a pre-crisis signal. When historically separate metals align like this, it suggests a systemic shift, not speculation. These moves reflect deep cracks forming in global confidence in currencies, debt markets, and centralized control. Gold's rally is the anchor. Silver's surge is the amplifier. Platinum's breakout is the industrial warning. And when those three signals align, history says we are entering unknown territory. Every great market story has a conflict, and in this one, the lines are clear. On one side, central banks, bullion banks, and financial institutions, entities with access to derivatives, futures, and opaque balance sheets. On the other side, investors, industries, and nations scrambling for physical supply in a world where trust in fiat money is eroding. The metals market is no longer just about price. It's about control versus scarcity, and scarcity is winning. Silver's 2025 breakout wasn't luck, and it wasn't a meme-driven frenzy. It was the delayed reaction, 2 years of ignored structural stress. Industrial demand surged as electrification accelerated globally. Solar panels, EVs, energy storage systems, 5 grams infrastructure, aerospace, and advanced electronics all rely on silver's unmatched conductivity. Unlike gold, silver is consumed, not just stored. At the same time, supply quietly failed. Mining output declined across multiple major regions, or grades fell. Costs rose, environmental restrictions tightened, and geopolitical conflicts disrupted shipping corridors and refining routes. The system was already strained, then demand hit like a tidal wave. That's when silver broke free. One of the most powerful signals in the metals market is the gold-to-silver ratio, and during the 2025 rally, it collapsed at a speed that shocked even veteran traders. This ratio acts like a pressure gauge. When it snaps lower rapidly, it signals stress inside the monetary system. Think of it like a fault line. Gold moves first, silver moves violently after, and in 2025, that fault line shifted fast. But here's where the story turns dangerous. As silver rose, analysts uncovered something deeply unsettling. Several major bullion banks were sitting on historic short positions. These weren't small hedges. These were massive exposures built during years when silver was assumed to stay range-bound and controllable as prices climbed. Margin requirements increased. Hedging strategies destabilized. Volatility spiked. Every dollar higher wasn't just a price move, it was pressure. Pressure on balance sheets, pressure on credibility, pressure on control, and once pressure builds in a market with limited physical supply, something has to give. While retail investors celebrated silver's gains, central banks were executing a much larger strategy quietly, methodically, and with historic scale. Across Asia, the Middle East, and emerging markets, gold buying surged to levels not seen in modern financial history. Thousands of tons were added to reserves as protection against currency instability, sanctions risk, and geopolitical fragmentation. This wasn't speculation. This was preparation when central banks move in unison. They're not chasing returns, they're hedging systemic failure. Here's the connection most people miss. When central banks hoard gold, investment capital naturally rotates into silver as a leveraged monetary metal. Silver becomes gold's volatile shadow, smaller market, tighter supply, bigger percentage moves. This dynamic amplifies every shift in sentiment, and it didn't stop there. Several central banks began exploring multi-asset, commodity-backed reserve frameworks, tightening liquidity across the entire metals complex. While silver isn't officially accumulated like gold, its role inside the system is quietly expanding. Gold is the anchor, silver is the accelerator. No silver story is complete without confronting the role of major bullion banks, especially JPMorgan. For years, accusations, investigations, and legal actions suggested price suppression through derivatives and futures structures. Whether you believe every claim or not, one fact is undeniable. Banks dominate the paper silver market, but something changed in 2025. As silver surged, analysts noticed banks quietly reducing short exposure, not announcing it, not advertising it, just repositioning. JPMorgan's own research arm began warning about structural silver deficits, a stunning shift from years of dismissive commentary. When the players accused of controlling the market start warning about shortages, you should pay attention. Let's be clear. This doesn't mean manipulation vanished. It means control is weakening. As mining supply tightens and demand becomes harder to forecast, traditional suppression mechanisms lose effectiveness. Futures markets can't deliver what vaults don't contain. Paper promises collapse when physical metal disappears. Banks aren't panicking. They're adapting, and adaptation at this scale signals a new phase of the market. Silver mining is entering a structural decline, or grades are falling. Extraction costs are rising. Environmental regulations are intensifying. Several top producing regions reported output drops in 2024 and 2025, with further declines. Projected into 2026, mining isn't like software. You can't scale it overnight. It takes years, sometimes decades, to bring new supply online. Now combine that supply collapse with industrial reality: solar panels, EVs, energy grids, aerospace, defense systems, medical technology. Silver isn't optional, it's embedded. Even small production declines create massive imbalances. Some analysts warn that by 2027, global silver demand could exceed supply by record margins. This is the fuse. Everything else, banks, geopolitics, monetary policy, is just the spark. Silver's 2025 rally shocked the market, but strategic analysts agree on one thing: it was not the end. As we approach 2026, three forces are converging. First, over 50% of retail traders expect silver to dominate again. Retail momentum matters during institutional repositioning phases. It amplifies volatility and accelerates breakouts. Second, experts believe platinum could disrupt markets due to industrial bottlenecks. That doesn't weaken silver, it strengthens the entire metals complex by redirecting capital into hard assets. Third, central banks are not slowing down. Gold accumulation continues at record levels, signaling preparation for deeper instability. If these forces align, analysts project another multi-digit silver rally, potentially exceeding the intensity of 2025. Fibonacci extensions, historical cycles, and supply-demand modeling all point toward elevated volatility with asymmetric upside. Short-term, violent swings, consolidation, shakeouts. Long-term, structural repricing. This is how secular bull markets behave. The metals market is no longer driven by simple curves. It is being reshaped by collapsing mining output, suppressed above-ground reserves, institutional repositioning, geopolitical fragmentation, relentless central bank accumulation, electrification demand, and retail-driven volatility. These forces are no longer theoretical. They are active, compounding, and accelerating beneath the surface of the global financial system. Silver's 127% rise was the alarm bell. Gold's relentless climb is the confirmation. Platinum's surge is the industrial warning. And JPMorgan's shifting tone is the signal that the system itself is adjusting to a new reality where scarcity matters more than narrative. The question is no longer, will silver rise again? The real question is, how large will the next shockwave be, and who will be positioned before it hits? Because by the time mainstream media admits what's happening, the opportunity phase is already gone. This is the moment where cycles separate winners from spectators. Markets don't move politely, and they don't wait for consensus. They reward preparation and punish hesitation. Those who understand structural change move early, quietly, and decisively. If this breakdown helped you see the metals market differently, hit like. It tells the algorithm this information matters. Subscribe if you want deep, data-driven analysis without hype, and comment below with your view on whether silver or platinum dominates 2026. Most importantly, share this with someone who still thinks metals are boring, because the 2026 metals cycle isn't coming. It's already forming beneath the surface, and storms don't wait for permission.